This is Professor MoneyPigTrading. Today is July 24, 2021. We're going to talk about how to trade options chapter 4, vertical debit spread. It's a very useful strategy and constantly can give you 100-ish% profits with defined risk, and pretty much use it every week right now. And also, if you live overseas, or you have to work during the daytime, this is actually a really good strategy because you don't have to pay that much attention compared to like a long call or long put options, since this contract price usually moves slower while still give you a really good return. So really quick, we're not registered financial advisor. This is just a tutorial and provide education contents. Please invest at your own risks. If you haven't liked this video, make sure to like it. That will help our YouTube channel tremendously. We also have a really profitable Discord community. Make sure to check it out if you're interested. www.moneypigtrading.com, and follow us on Twitter, YouTube, Instagram, MoneyPigTrading. So we also put these option tutorials in our website, moneypigtrading.com/tutorials. You can get all the links and the chapter title in that website, or you can simply just subscribe our YouTube playlist and get the latest option tutorial contents. So a lot of people ask, and we mentioned in the previous video, if I have $1,000 to start with, how much can I make? And that's not the right question. The right question is how much risk you can take, because investment is all about risk management. And when your risk is pretty much unlimited, your returns can be unlimited, and so does your loss, which can be unlimited as well. So here we're going to talk about strategy vertical spread, which can provide you a defined risk. And the previous 1, 2, 3 chapter, we mentioned about long calls, where we're going to put a video link up, on the upper right corner. And then we also mentioned about long puts, which is the chapter 2. And then the chapter 3 will talk about sell calls and sell put options. And combined together, we can now discuss a more advanced strategy called vertical spread. And once you understand vertical spread, you can use even more advanced option strategy like butterfly spread, iron condor, which pretty much is putting two vertical spread together at the same time. So what is vertical spread anyway? So let's take a look at one of the very first vertical spread we're going to discuss. It's called long bull call debit spread. So what is it? So basically it's a long call options with a lower strike price, and then at the same time you sell the call options with a higher strike price. And if you have any question about what is a call options and what is the strike price, make sure to check our chapter 1, and the link is at the upper right corner again. So let's take a look at Long XYZ 92 to 97 vertical bull call debit spread as example. Here, vertical bull call debit spread means you are betting the underlying asset, here is XYZ, or it can be a crypto. The price is going to go up. And when the underlying asset price go up, your option contract price will go up as well. So here, to construct a vertical bull call debit spread, you need two contracts. We call it two legs. First, you have to long the XYZ 92 call. And in the meantime, you are going to choose a higher strike price. Here, we use sell XYZ 97 call with the same expiration day as an example. Here, your max loss will be 100% because you're going to pay a certain price for this vertical spread. And the worst case scenario, you're going to lose 100% of this money. And the maximum gain here is the strike price between the two, which is 97 minus 92, equal to $5 per contract. And so you have a very defined risk, which is 100%, and you also define your maximum gain, which is $5 per contract. So let's look at the option plot here. So assuming you're a long XYZ 92 to 97 vertical bull call debit spread, again, that means you're betting on XYZ price will go up, and hopefully this option contract 2 legs will go up as well. So let's look at the orange line first, which is the contract option expiration date. We mentioned the maximum price is 97 minus the 92. So if XYZ traded at $97 or above $97 at this contract expiration date, we're going to say these 2 legs are in the money. And your maximum price is $5 because 97 minus 92 equal to 5, right? So if the XYZ traded before $97 or at $97 at contract expiration date, you max out this contract, $5. Congratulations. However, if XYZ is traded between these two kind of strike price, $92 and $97, you're still going to have values in your contract. The way to determine the value is whatever XY is traded at the option expiration day, like here, for example, $94, minus the first leg of the strike price, which is 92. 94 minus 92 is $2 per contract. So that means this particular vertical bull call debit spread will be traded at $2 per contract at the option expiration date. However, the worst case scenario is if the XYZ is traded at 92 or lower, that means this particular vertical bull call debit spread will expire worthless, $0 per contract. So you're going to see this, your risk is very defined. You're not going to lose any money more than 100%. In the meantime, you're going to cap up your gain, which make it this contract move slower. Let's look at our blue line option price before the expiration date, right? So the higher the price goes up, that means your price is going to more slowly than what you see in the previous video, chapter 1, like just by simply using long call options. Even though the downside is you cap out your maximum gain, but in the meantime, that means your contract price moves slower. You don't have to watch it all the time. Perfect for people who live overseas, or you have a full-time job. You cannot just watch it all the time. Also, usually before the option expiration date, even though the XYZ is traded above $97, and that means both of your legs are in the money, your contract price usually is not going to max out at $5, especially it's very long, far away from the contract expiration date. You're probably going to see it be traded like 3.5 or $4.5 before the expiration date, even though both legs in the money. It's because before the expiration date, things can change, right? XY can drop back all the way, make your contract out of money. So there's a risk. Nobody want to pay you, like $5 to buy your vertical spread at the moment. That's why you're going to see this blue line. But the closer the option is going to get into the expiration day, you're going to see your contract price is going to getting closer to max out, which is a $5 per contract. And in my personal opinion, I usually take profits. Like, if it really reach like 90% of the max price, a few days before the expiration day, usually I just take a profit. The risk of holding it longer to get that last 10% of the max price is usually not worth it. On the other hand, if you are betting on the underlying asset will go down, here you can use another vertical spread strategy called long bear put debit spread. So pretty much it's a very similar thing, but totally the opposite way. You long the put option with a higher strike price, and then you sell the put option with a lower strike price. So here again, as an example, your betting XYZ will go down. You're using 97 to 92 vertical bear put debit spread. You long the XYZ 97 put option, and then in the meantime, you sell the XYZ 92 put option with the same expiration date. Your maximum loss is 100%. Your maximum gain is $5 per contract, which is 97 minus 92. So if we look at the option price plot again, is pretty much the opposite. So the maximum price is 97 minus 92. If XY is traded below 92 or at 92, you're going to max out your contract price. Same way, if you're traded between 97 and 92, your bear put debit spread will have certain values. If XY is traded above 97 or above, then your at the expiration day, then your vertical bear put debit spread is going to be worthless. So just some pros and cons compared to long call put options directly and vertical spread. The best use cases is you really need a really good momentum. When the stock, underlying asset, or crypto go up a lot, then long call or long put option will give you a handsome return. But not every day is Christmas, right? Oftentimes you're going to see a very small move for this underlying asset, maybe 0.5% for the whole week. Then that's a great time to use vertical spread. When you're not very confident that it's going to be a really big direction move, then you just use vertical spread. Or in a shortened time frame, usually means the momentum will be less, right? And then use vertical spread. Then you will have still pretty good return, but less risk as well. And just by using long call put option, you're going to have higher risk because, like we mentioned in chapter 1, if the underlying assets drop like 1%, you probably lose like 50% of your long call or put option very quickly. While vertical spread move very slowly, as long as your contracts like far away from the money or both legs in the money, in most cases the price will move pretty slowly. Even the stock price drop 1%, the vertical spread is probably only going to drop 10% in that case. However, for the profits, a long put call and put option is kind of unlimited. So if the price go like one way exponentially, then your option price is going to go exponentially. On the other hand, vertical spread on the downside is In that case, we'll lose some potential profits because compared to the long call or put options, because you kind of set a cap in that case, and you cannot enjoy the further profits like compared to you just simply use long call put options. However, your life quality will be very different because when you long call or put options, a lot of traders have stomach issue because you require more attention. The price moves so volatile, very volatile, right? So you're probably going to be nervous all the time. Well, if you're at work or you work or live overseas, vertical spread is a perfect option because the price moves slowly, max out the profit cap. But in the meantime, you require less attention. You don't have to worry about it all the time. And also the option counter price costs, we could say premium, is usually way higher in the long call and put option, especially if you're looking at like mega cap stock like FANG. If it's just simply long call or put options, usually going to be ridiculously expensive, especially before some special events like earning reports. On the other hand, the vertical spread, usually the option counter price will be lower. And that's why we love it so much, because with the less price, less risk, you're still going to get decent returns. On the other hand, commission fees, usually long call and put options are cheaper because you only need one leg. On the other hand, the vertical spread will need two legs, so that means the commission price cost will double. The other benefit of using long call or put options is the margin requirement is none. So you can simply use it to buy using your cash account. On the other hand, in the United States, in the US market, if you want to buy a vertical spread, that requires you to sell the call or put option. That means you have to at least to have level 2, level 3 option trading requirement, which you will have to have a margin account. That also means your account will be subject to pattern day trading if you have less than $25,000 in your account. We'll mention that in the account setup tutorial. So last, we actually have a benchmarking account in the last 2 months. This account actually go up at one point about 1,500%, starting around $1,500 and reached $20,000. Currently dropped back down a little bit because of the market, but still pretty decent. And one of our members, actually several members are doing well. In this particular member, in a month when he joined on June 24th, he started around $2,200. And after 1 month, as of today, July 24, his account is actually growing to $12,000, almost $13,000. So about 540% return, which is pretty decent. So if you're interested in a Discord community, make sure to check us out, www.moneypigtrading.com. Also Twitter, YouTube, Instagram, MoneyPigTrading. Thanks for watching. In the next video, we're going to talk about the practical cases for vertical spread, and also going to talk about vertical spread in credit in the next 2 videos.